In 2008, the US government bailed out the banks. And then they passed a bunch of rules to make sure that a financial crisis would never happen again. But now they're about to repeal those rules on purpose. Why? Because now they need the banks to bail out the US government. If you don't know who I am, my name is Joe Brown. I am a former stockbroker and now I run Heresy Financial, where I help active investors decrease portfolio risk and increase long-term returns. So, how did we get here? Let me catch you up to speed. After the financial crisis hit and the bank bailouts, the US government passed a bunch of rules, a bunch of laws, a bunch of regulations in order to prevent banks from being able to take on the same type of risk that led to the swift collapse. The main one that matters to what we're talking about today is that banks had to make sure they had a certain amount of capital for the assets that they have purchased. And whatever the asset is that they are looking at buying, there are limitations on how much of those assets they can buy. The goal was very simply to just make sure that banks didn't become over leveraged again in any investment. And that brings us to the problem today, which is that banks are also limited in how many US Treasuries they can buy. Now, this makes sense because US Treasuries are not risk-free. They are commonly considered risk-free because as long as you hold them to maturity, you're gonna get your principal and interest back. The only way a government defaults on debt in a currency that it prints is if it just chooses to default. But that one little phrase, as long as you can hold on until maturity, actually matters a lot here. Because as we all witnessed a couple of years ago, many banks were not able to hold on to treasuries until they matured because there were bank runs happening and people were withdrawing their assets, their cash out of the bank, and banks were having to sell their treasuries. The problem was these banks had bought these treasuries when interest rates were near zero and interest rates had gone up, which meant that the banks, even selling all of their treasuries, were not able to produce enough for all of the deposit withdrawals. And if you've been watching my channel for a while now, then you probably know I'm a fan of hoping for the best while preparing for the worst. So if you're anything like me, you probably realize that there is a lot of potential in the markets right now, but there are also a growing number of risks as well. And that's why coming up on Thursday, June 12th, at 7 p.m. Eastern time, I'm hosting a free live Zoom call to cover the Black Swan trade. This is a completely unique strategy that allows you to profit from surprising events. And after using it in my own account to take home some pretty big returns, I'm gonna share everything I've learned with you. I'm even going to give away a free signed copy of Nassim Taleb's book, The Black Swan, signed by him, not me, to somebody during the call. All you have to do is click on the link in the description below, register, show up for the event. It's on Thursday, June 12th at 7 p.m. Eastern time. Again, attendance is completely free, but spots are limited, so don't wait. Look forward to seeing you there. The way the Federal Reserve handled this new risk, where treasuries were no longer risk-free because we are in a new environment where interest rates are going up, is that they launched the BTFP, the Bank Term Funding Program, which basically said if you're a bank, you can temporarily sell your treasuries to the Fed for full price, as long as you buy them back within a year. To put this into a personal financial situation so that it makes sense, imagine you borrow a bunch of money from a friend. You take that money and you go invest it in Amazon, Apple, and Google. You think you're gonna make a good amount of money and then you're gonna pay them back what you owe them. You'll be able to keep the difference. The problem is Apple, Google, Amazon, they all start to fall right when your buddy asks for his money back. So you need to go access the Fed's BTFP instead of selling those shares on the open market for 50% of what you bought them for. You're going to sell them to the Fed for exactly what you paid, even though that's not what those shares are actually worth. And the only thing you have to promise is that you'll buy those shares back within a year. So of course you're going to do that, and that's what every bank did that needed it. This meant that depositors at every bank across the country no longer had to worry that their bank was sitting on a ton of unrealized losses on all those treasuries, because if they needed to get the money, they could by temporarily selling those at full price to the Fed. Now, the BTFP is no longer active. It was a temporary facility that the Federal Reserve started to deal with that crisis, and it's been shut down now. But the precedent has been set. And if push comes to shove, that or another program like it will absolutely be launched, which means that US Treasuries, for all practical purposes, to a bank, basically fungible with reserves. In other words, kind of the same thing. Because if a bank holds a US Treasury with that implicit temporary Fed bailout looming in the background, they don't just have to hold on to it until maturity for it to be risk-free. They can sell it to the Fed prior to maturity for full price, which means no matter what, US Treasuries to banks are risk-free. Even so, banks are still limited in how many treasuries they can actually purchase, which is a problem for the US government because interest rates on US government debt have continued to rise. With the tax cuts planned and spending still increasing, the interest on all the existing debt still going up, the US government is borrowing more and more every single year, but they have fewer and fewer places to borrow from. This is a chart of the Federal Reserve's balance sheet, and you can see for a couple years now, it's been declining, which means that as some of the debt that they own from the US government gets paid back, they are not lending it all back out. Some of it they are just letting retire. In other words, if the US government pays back, let's say $100 billion to the Fed that it owes to the Fed will turn around and maybe loan 90 billion of that back to the US government. So the Fed is not a net growing lender to the US government anymore like it was during QE when the balance sheet grows. Foreigners are also becoming less and less of lenders to the US government, buying fewer and fewer treasuries. One of the reasons why gold has been in such a strong bull market over the last couple of years, because gold is increasingly taking the place of US treasuries on balance sheets around the world. In other words, demand for US government debt is declining, right at the same time as the US government's appetite for borrowing is steadily increasing. And because nobody is jumping in to pick up the slack, interest rates are rising. And this is the reason why the US government is considering bank deregulation. Even though the rules that are set to be repealed were set in place in order to prevent a 2008 style crash, the crisis that the US government is staring down the barrel of would be worse. In other words, if the banks collapse, that's a big problem. If the US government runs out of lenders, it's game over. At least for them, not for anybody who's actually prepared. Regulators are expected to propose cutting the supplementary leverage ratio this summer. And this is something that earlier in the year, Jerome Powell suggested could help the Treasury market. In other words, this would allow banks to buy either a lot more or potentially even an unlimited number of US Treasuries. Given the fact that for a bank, a US Treasury is risk-free if you hold on to it maturity, and it's risk-free if you can sell it to the Fed for full price temporarily, there would be no risk reason to prevent banks from buying as many treasuries as they wanted. And because US banks are able to loan money into existence, they would have the incentive to do so because every treasury they buy would just be more income for them. In other words, all return and no risk. If these rule changes go into effect, we unleash major bond buying in the US Treasury market, which would push interest rates down across the entire yield curve. The government will be able to roll over a lot of their higher interest debt into lower interest debt, which would help out with the total cost of the national debt right now. And if this sounds a lot like quantitative easing, then you're right, because this is QE just without the Fed. In fact, the Fed's balance sheet could still decline and the banks would make up the slack. This is QE through the banks. Now, there are a few major implications for both markets and the economy from a move like this. Number one, we are going to have higher prices because this allows a lot more spending from the US government, but their spending is money that is coming into existence for the first time. In other words, it's an inflationary financing deal. It pushes prices of assets and goods and services higher. And even though rates on US government debt will go down, interest rates, after maybe a brief period of falling for everyone else, interest rates will actually go up. This is because lenders who do have to take on risk, in other words, lending to people like you and me, have to compensate for the inflation along the way, which means that even though the government will be borrowing at artificially low rates from banks doing QE, people like you and me will actually have to pay higher interest rates. This is also going to happen as a result of the crowding out effect, because if you're a bank and you can loan to the US government risk-free, then you're going to demand a higher and higher interest rate from somebody in the private sector who does represent some risk, especially if that means you have to watch out how many of those loans you make as a bank versus loaning to the US government. It's a lot more free and open. So there will be a crowding out effect and it will actually hamper economic activity. Now, if you're sitting there thinking, oh man, I have no idea how to play this, and if you want me to help you, don't worry, I've got you covered. That's why I'm hosting the Black Swan Trade event. Remember, it's Thursday, June 12th at 7 p.m. Eastern time. And if you haven't done so already, click the link in the description below to sign up. I will see you there. As always, thank you so much for watching. Have a great day.